Hey traders, what's up? This is Corey, aka Sell the News, and thank you so much for joining me again. I'm super excited for this video. Today we're going to learn about a lot of the basics of the stock market. I'm going to cover a ton of topics, very high level, and give you the links to go and research a little bit more in depth as you go. All of the topics in today's video will each have their own video because they're all very important topics. But today we take the first step to becoming a millionaire. And so I really am excited for you guys joining me. Wouldn't mind, before we get started, please like the video and please subscribe to my channel for more content coming up in the future. You guys aren't going to want to miss it. We really are going to lay out everything it takes to become a successful trader. And the first step really depends on a strong foundation. Every single house, every single structure that is built has a very strong foundation. That's what we're going to work on today. So the first thing we're going to talk about is what makes up a market. A market is made up by buyers and sellers. They will put in what's called the bid for the buy and the ask for the sell. The difference between the best bid and the best ask is called a spread. A trade will not happen unless the best bid moves up to the price that the best ask is, or the best ask moves down to the price that the best bid is. That's how a transaction occurs. So what you will see on the screen right now is the level one. You will see the best bid, the best offer, and you'll also see the last price that the shares traded at. Now you also have what's called the level two, a list of all the bids and all the offers in the market currently. Now you'll also have what's called the time in sales, which is off here to the right on this level two box. And that shows all of the trades that are going through currently. And so again, I will explain this further and how to use it and for future videos. Now that we've covered what a market is and what makes up a market, let's talk a little bit about the different types of trading. You have buying a stock, which is what everyone thinks of. They also call this going long a stock or taking a long position. But you also have shorting a stock or selling a stock before you actually have the stock in your possession. It's called shorting. You're taking a negative position, borrowing the shares, selling them into the market, which we will go into in further detail here in a minute, and hoping that the value of the shares go down in value. Some of the different types of trading that you will hear about and that we will talk about in the future on this channel and more in depth in this video is day trading, which is in and out of a position in the same day. Now you also have swing trading or position trading, which is taking a position either long or short and holding for multiple days to weeks to months. So now let's circle back to short selling for 1 second. So I want to explain this in a little bit more detail. There's a documentary on Netflix called Betting on Zero with Bill Ackman, where it follows Bill Ackman and his massive short position that he takes against Herbalife. And in that documentary, he explains what short selling is. He explains it a little bit like this. Say that you have a coin worth $100. I think that that coin's value is going to go down in value in the next month to 2 months. So what I will do is I will come to you and I will say, can I borrow your coin? I will pay you interest to allow me to borrow that coin. I will then take that coin and sell it into the market for $100. So I now have $100. I've sold the coin into the market, but I still owe you the coin who I borrowed it from initially. So now the value of that coin does drop. It drops to $50 per coin, say. I will then go into the open market, buy that coin back, return the coin to you, pocket the $50 minus interest that I paid you, and that is short selling. So we do that with stocks. Long-term holders of a stock with a margin account. The person has to have a margin account, which we'll talk about the different types of accounts here coming up shortly, margin for cash, but just know in this example, someone that is going to loan their stock out to be shorted has to have a margin account. You'll notice that when you open your brokerage account, and when we walk through that in a future video, you'll see there is an option that you can check to say, allow my shares to be loaned out to short sellers, essentially. So in this example, the long-term holder checks the box, allows his shares to be loaned out. You want to short that stock, so you go to your broker in your brokerage platform, which we'll walk through on the video on placing a trade, and you go up and you sell 100 shares into the market short. You are now minus 100 shares. You will have that, it'll show up in your account. So the value of that stock goes down. You then buy the shares back, and once you place that buy order, you pocket the difference and the shares are returned to the person that you borrowed them from. Now, all of this happens behind the scenes at the brokerage. You do not deal with it. All you are doing is going into your brokerage platform, you're placing a sell order, and then when it comes time to buy it back, you're placing a buy order. You are literally doing the reverse of what you typically do when you buy a stock and then sell it once the value goes up. Okay, so we've now got a little bit of the basics of how the stock market is made up, what kind of trading, what types of trading there are, and what short selling is versus what taking a long position is or buying a stock. Now let's talk a little bit about what the capital requirements are for opening a trading account and starting trading. When it comes to opening an account, there are two types of trading accounts or brokerage accounts. The first type of account, the cash account, which I mentioned earlier, and the margin account. So the other type of account is a margin account. A margin account is what you want if you want to be able to short stocks, if you want to be able to take leverage. And to open a margin account, you're going to need $2,000. There are ways to trade with whatever amount of money you have, but as we get into this more, you'll see that the key is to even paper trade or trade very, very, very small at the beginning because you will take losses trying to find your setup, trying to find your niche, and you want to lose small in the beginning. So circling back to the settlement and the cash account, you are not allowed to short stocks in a cash account, but you are allowed to take as many trades as you want as long as you are using the settled cash in your account. Now, I personally will always recommend a margin account. I do recommend also when it comes to paper trading versus trading with real money, but trading very small, I recommend trading with real money because you actually get the execution. This brings us to the next topic, which is the bane of every small trader's existence, which is the PDT rule or the pattern day trader rule. What this is a rule enacted by the Financial Industry Regulatory Authority, or FINRA, which is authority that regulates financial markets. Now, what the pattern day trader rule is that any trader that engages in 4 or more day trades in a rolling 5-day period or 5 business days gets flagged as a pattern day trader. And in order to actually engage in this activity, you have to have at least $25,000 in your account at all times. If you drop below that, then you get flagged as a pattern day trader, and unless you put money in your account to get it above the $25,000 threshold, then your account gets frozen. It gets frozen for 90 days. I've violated pattern day trader many times, and each broker typically allows 1 reset. E-Trade says that it's a one lifetime reset. Some brokers say every 90 days they allow a reset. It's really kind of up to your individual broker. Like, I'm thinking of Interactive Brokers, for instance. I believe theirs is a 90-day or 180-day reset, something like that. So if you do violate it, don't worry. There is a reset that you're allowed, and your account won't be frozen for the full 90 days. Now, it's important to remember that the pattern day trader rule does not apply to cash accounts. It only applies to margin accounts. Now, there are some ways around the pattern day trader, which we'll talk more about when we get into our broker video. But for instance, you can open multiple brokers and split your starting balance or your investment amount into several different brokerages so that you have 3 day trades for every single brokerage account that you open. I've tried that method and it's worked well. I've also focused on swing trading when I can and take the trade overnight. There's a different definition for each broker as far as scaling in and scaling out of the trade when it comes to defining a day trade. There is no question if you enter the trade and exit the trade on the same day. We will talk about that in the brokerage video and for future videos. So now that we've talked about the pattern day trade rule and the different types of accounts, let's talk a little bit about the different classifications of stocks. So every stock has an underlying business, of course. The way that those underlying businesses and the stocks are valued is by market capitalization. What the market capitalization is the number of shares outstanding times the current share price, which gives you the market capitalization. So market capitalization, or market cap. Stocks are bucketed into several different categories. We're going to talk about them here right now. So the first one is a micro cap stock. A microcap stock, it has a market capitalization of from 50 million to 300 million. Now the next one is a small cap stock. Small cap stocks are anywhere from 300 million to 2 billion market capitalization. So these are slightly bigger. Next one is a mid cap stock. A mid cap stock is anywhere from $2 billion to $10 billion market capitalization. So then the next bucket is the large cap stocks, which is anywhere from 10 billion to 200 billion. And then the mega cap stocks, which are the Tesla, the Apples, the Amazon, a lot of the blue chip stocks, are anywhere from $200 billion market capitalization on up. So I'm showing on the screen right now Thinkorswim, which shows the market cap of the company in the top left there underneath the share price. But it also shows the number of shares outstanding, which is what you use to calculate the market capitalization. Most people go by the share price and they don't realize that a $2 stock can have a market capitalization of 500 million to $1 billion or even above that. And then a $10 stock can have a market capitalization of 50 million or below that. The share price does not matter. It is the market capitalization that matters. And that's a very, very important thing to remember as we go forward. I'm going to talk more about SEC filings in an entire video dedicated to SEC filings and how to read them. But for right now, just know that they exist and that you can look at them at the SEC's website, which is called EDGAR. I will put a link to that in the description so that you guys can go check that out. There's a few other places you can get SEC filings. Another one that I like to use is called BAMSEC, BAMSEC.com. Another one is OTCmarkets.com. OTC Markets is the next exchange that we'll talk about, and that is an exchange for smaller stocks, usually penny stocks or stocks that are not listed on the major exchanges like the NASDAQ or the NYSE. These are the stocks that are a little bit, some would say, more scammier or sketchier, a lot of penny stocks, and sometimes are just shell companies, don't actually have an business. The three different exchanges within the OTC markets are the OTCQX, OTCQB, and then the pink sheet stocks. And each of those have different requirements. Some of them aren't required to do any kind of SEC filings or anything on the pink sheet stocks, but they all have different requirements, which we'll get into at a later date. Another big difference with the OTC markets is that they trade differently. A little bit of a different trading mechanic than the listed stocks. The listed stocks, every single one of those use electronic market makers. And so you place a trade, you're buying a share, say for instance, and you place your bid above or at the best offer or the best ask, you will instantly get filled. It's because it is electronically placed and it's filled instantly. Now with the OTC markets, you could place your bid above the best ask, and it could take several minutes for your order to get filled. That's because many of the exchanges on the OTC markets are actual people executing those trades. There are some electronic market makers on the OTC exchanges, but for the most part, they are people actually pressing buttons and actual people behind those market makers that are executing those trades. That's a little bit of a deep dive that we'll get into at a later date, but I just wanted you to know that it exists, and it's a big difference between the OTC markets and what we call the listed markets, which are the NASDAQ, the NYSE, Amex, and so on. All right, traders, thanks so much for sticking with me to the end. If you did, thanks for making it this far. I think we covered a lot of great information, all of which I will include links in the description so that you can check it out and research it a little bit more on your own. We will go into detail on every single one of these topics because they're all important. Thank you for joining me. Please like and subscribe to the channel, like the video. See you in our next video, and thank you so much.